Hi, Grant. Thank you very much for joining us today. How are things in Saskatoon?
Yeah, it's a pleasure to be here, and summer's finally arriving on the prairies. So wonderful time of year.
Grant, May and June have been very conference heavy, and you and your team have been on the road meeting with investors all across North America. What are the common themes or questions that have come up during your discussions with institutional investors?
Great question. A couple of themes. Number one, and this is really good news, the debate seems to be over. When we were saying that the risks to supply were far greater than the risks to demand, we were still having to argue that with some folks, and nobody seems to want to argue that anymore. So that's a major theme. Walking through what are those risks to supply as we really are in unprecedented geopolitical times, which gives rise to the next theme, which is geopolitics. We're spending a lot of time talking about what a bifurcated market looks like and how folks should think about the need for supply and where there's going to be a need for supply in a market that bifurcates. And that's an important focus for sure. If there's a third theme, it really is the reminder that unlike natural gas or unlike coal, you don't take uranium oxide and throw it into a reactor. Uranium is a really important part of the product, and it is the product, but then you have to add some really important services to it. The service of conversion, the service of enrichment, and then the service of fabrication. And with the attempts to exclude Russia from the Western nuclear fuel supply, the typical uranium investor has been really forced to understand what that nuclear fuel cycle actually looks like. And it is different, and it's more complicated than just throwing coal in a furnace and producing power. It is quite a bit to get your head around it. So we've been spending a lot of time on the complexity of the nuclear fuel cycle. And, if there's a final theme, it's just this question of, okay, if the risks to supply are greater, if we are in a bifurcating market, if the demand outlook is strong, why aren't prices doing better? And so then it's the reminder that, well, again, unlike coal and natural gas, there really isn't a spot market. Our utility customers are dealing with these challenges. They're working their way back upstream from enrichment through conversion. It's led to a bit of a pause in the uranium space, but here's the good news. Enrichment jumped by $50 a couple of weeks ago and jumped by another $10 this week. Conversion's never been priced higher than it is today. And that demand that's right now focused in those services needs to ultimately come into the uranium space, which is the product those services are applied to. So that's what we've been talking about for the last number of weeks.
That's great. I'm glad you brought up conversion. I want to speak more about that later, but right now I want to talk about the term market. So much has changed since we last spoke in March, and I want to get your thoughts on how the term market has changed. You have referred to this period after the Russian invasion as Russian replacement period, and the market's gone from one of long-term in nature, focused on longer-term contracts, bigger volumes, to one more focused on enrichment. Can you just speak to this, please?
Yeah, and by the way, I'm glad you start with the term market, and I think it really is a testament to how well you understand the uranium space. This isn't a spot-driven model. This isn't a world where the spot price goes up and then we rush ahead with our demand or our supply, whether it's in uranium or whether it's in the services, to try to meet spot prices. That's not how you capture value in the uranium market. And anybody who tries to tell you that clearly doesn't know what they're talking about in this industry. So you really do have to look at the term market. The term market was very focused on uranium in 2021 and in early 2022. In 2021, it was really the fundamentals were improving, and utilities were turning their attention to the long run rate requirements for their reactors on the uranium side. And then, of course, the geopolitical situation in Kazakhstan in early January really consolidated that focus on the uranium space and led to quite a bit of success for us in the early part of 2022. And then February 24th happened. And February 24th actually took the attention away from the uranium segment and moved it downstream. You know, as you know, the Russians are 40% of global enrichment, a quarter of the US market, a quarter of the Western European market. They're 30% of the global supply of conversion. That's about the same size we are. And so utilities who thought they were really well covered on those very important services are suddenly realizing, you know, they need a different strategy here. And so we're seeing, if not, we haven't seen formal sanctions yet on Russian nuclear fuel, but we certainly have seen self-sanctioning going on. Vast majority of Western utilities believe it's a question of when, not a question of if. They've got to get off Russian supply. So that contracting focus shifted downstream to enrichment and conversion. So it's giving rise to the prices I referenced earlier, a 60% jump in the long-term price of, or $60 jump in the long-term price of SWU in the last several weeks, and conversion prices that have never been higher. And that's come at the expense of that laser focus that was on uranium earlier in the year. But the good news is that demand doesn't disappear. It's just been delayed. And now likely the uranium demand will show up in a far more concentrated way, which is always great for price discovery.
Given Russia supplies 14% of uranium production and is responsible for 27% of conversion, 39% of enrichment services, can this new green world, or a world focused on decarbonization, proceed in a world without Russia?
Yeah, you bet it can. There are resources on the uranium side that are on what you might call the western side of the map. There are resources in the conversion space. Conversion began its supply discipline before uranium did, actually several years before uranium did. And conversion can increase in capacity, and there can be reinvestments in Western enrichment, including our project, Global Laser Enrichment, which we're pretty excited about. That's not for tomorrow, but that is for a Western market that is really trying to, on a long run basis, secure Western capacity. So it is possible, there's no doubt about it. It will take time and it will take money, because in most cases, the Western cost curve for those services and for the uranium is just higher than it is when you include Russia and Central Asia, for example. And so prices will have to respond. They will have to respond to levels that are encouraging those with the productive capacity to go ahead and invest in it, and know that they're investing in it for returns over a substantial period of time. So it absolutely can respond. In the near term, this is a moment of destocking. This is why utilities carry inventory. Precisely for situations as this. So we'll see some destocking, probably see some strategic inventories be available. Then we'll see the productive capacity increases, and then the Western world can meet its needs by excluding Russia.
And you've mentioned this many times before, but you've talked about the scarcity of supply and the concentration of supply. How has the term market changed here in the past 6 months, and do you think these changes will be permanent?
On the uranium side, the term market changed in some very significant ways through 2021 and into early 2022. And we just see these trends continuing. Number one, the carry trade has disappeared. And that's just a function of the spot market becoming tighter and tighter. So utilities don't have the ability to go into the spot market, buy significant volumes, or have somebody buy it on their behalf and carry it on an interest rate curve out into the early part of their term demand. That business has kind of gone away. Spot market's tight, interest rates are going up, doesn't make sense for carry trade. So what we've seen is the tenor of term contracts extend. Instead of a 2 to 4 year bite out of the market, we've seen 2 to 7 years, 2 to 10 years. We've seen volumes go up, not just because more years have been added, but also because they're just taking bigger bites and looking for a claim to that future productive capacity. And the timeframes have increased as fuel buyers become more confident in the life of their assets. They're more confident in stretching out their procurement terms in terms of time frame. And so we're seeing that increase as well. And even with a bit of a pause on the uranium side, while enrichment and conversion are the focus, we don't expect those trends to reverse.
So I want to spend a little more time on conversion, and many people think of Cameco as a miner only, but as you already mentioned, you're also involved in refining and conversion and fuel fabrication. And Cameco's conversion facility located in Port Hope, Ontario, it's the only operating conversion facility in North America. What capacity are you licensed for at that facility?
Yeah, that facility has a licensed capacity of 12,500 tons of uranium converted into uranium gas, which is the state it needs to be in to enrich. We've been producing as low as 6,000 tons a year, as we were engaged in very significant supply discipline on the conversion side, similar to what we were doing on the uranium side. And now we've been ramping it up, but it's the same focus for us as it is on the uranium side, which is the utilities actually have the most important tool in the toolbox here, and that's the tool of their procurement. Our desire to get to higher levels of production is a function of how much they want to contract. Again, we see a tight spot market for conversion, but that doesn't encourage us to sell into the spot market. That encourages us to see that spot market stay tight long enough for us to lock that value into multi-year contracts that become the basis for our production decisions in Port Hope. So we can go up a bit more, but that will be a function of the building of that contract book, our ability to layer in more conversion service sales, and as well our ability to take the demand for conversion and drive it upstream into demand for uranium by saying, we're happy to sell UF6. We're probably, we'll sell you the uranium and the conversion together as UF6. And so we're just in that process, taking advantage of this market and these prices we see to capture as much value for as long as we can.
And what capacity are you currently operating at?
Yeah, the Port Hope conversion facility is going to run about 10,000 tons this year as a function of the book that we have to deliver into, and then with spot prices as high as they are, there's opportunities maybe there a little bit, but really it's the longer term focus for us. It's translating a tight market into longer term value capture. Over time, we could get up to the licensed amount. Our plan would then be to run it at that licensed amount for maximum economics for as long as we can, recognizing the conversion market can respond to these higher prices. We have a facility. We don't have a facility. The industry has a facility in the U.S. that was shut down as part of supply discipline, and it could come back, produce 7,000 tons of conversion, maybe even 10,000 tons of conversion. There's a facility in France that's operating at about half of its intended production, but it also has some flex up on top of that. So we have to be very disciplined. The goal here is not to bring on a bunch of conversion production that drives down the conversion price into the future. The goal is to recognize it's an important service. It's an important service that's needed by the utilities. And we've got a very key facility, and we have the ability to underpin terrific margins in that facility.
And Grant, you touched on this earlier, but if you don't mind just repeating, what have conversion prices done year to date?
Well, and maybe a little bit more of a historical perspective, when we began the supply discipline in the conversion space, you would have seen spot conversion below $5 a kGU, and you would have seen term conversion $6, and these are US dollars, $6.50 a kGU. And I just happened to be looking at the price post the other day. The North American spot price for conversions over $30 a kGU, and the North American long-term price for conversions $24.50 a kGU. So we've seen a very substantial price response in the conversion business that we think, just it represents what we've been saying is characteristic of the uranium segment as well, and that is the risks to supply are greater than the risks to demand. In the conversion, we've now seen it, and therefore it's translated into pretty strong price discovery.
And you mentioned earlier that the U.S. facility, which is owned by Honeywell, they're in the process of starting up again. Is there a timeline associated with that?
Well, I can only go on what I've seen them put out, which is an intention to be up and running by the end of 2023. So I imagine that involves some commissioning in 2023, as whether that's ramped up to 7,000 tons or whether that's 7,000 tons on an annualized basis. I'm not sure exactly what the target is, but certainly it is a critical facility in the U.S. strategy to exclude Russia from the nuclear fuel cycle. And we've seen those folks in the industry for a long time. They're good operators. They'll get their plant up and running, and they'll be providing conversion services into our market.
I want to move on from conversion now and talk about your Q1 press release that came out here last month. And one of the things that was mentioned in there, you mentioned that there was a reemergence of RFPs versus off-market transactions. And to an outside observer of the uranium market, what exactly does this mean, and what can I read from this?
Yeah, so a bit of an update on that disclosure. We were seeing a pickup in on-market RFPs, but then as the attention became really focused on the enrichment and the conversion space, we then actually saw those on-market RFPs for uranium step back a little bit in the time since we put out that news. But why it's important to focus on is generally in our industry, our fuel buyers they swim upstream. They start with their services, fabrication, then they go to enrichment, then they go to conversion, and then they turn their attention to uranium, because now they know where those services are delivered and they know where to send the uranium. So they generally swim upstream. And generally when contracting begins, it often begins as what we call an off-market exercise. So the utilities that have more confidence in their fleet, looking at their run rate requirements, often come to those they already have contracts with and start to layer in new volumes, extend current contracts, perhaps new pricing mechanisms. But that's really kind of the quiet off-market phase. And then you start to see more testing of the market in the on-market RFPs. So then the next phase is you start to see more visible demand come into the market. And then ours is an industry where demand begets demand. Utilities, certainly they watch the supply side and they watch our announcements, but they also watch each other. And it catches a collective attention when someone comes out with an RFP, and so that we've just viewed that as a leading indicator over the years, and that's why we want to help people see the world through our eyes by pointing out when we're starting to see those signposts as we're driving down the road.
Great. I want to move on now and discuss your balance sheet and also capital allocation. As of March the 31st, you had $1.5 billion in cash and a $1 billion credit facility. How will you allocate this cash in the coming year?
Yeah. Our focus in the last number of years has been discipline. It's been marketing discipline, it's been production discipline, but it's also been financial discipline. And it's important to always remind everyone that, yeah, we've got a very strong balance sheet. This was on purpose. This was deliberate. This was to make sure that we were investing, and I use that word deliberately, we were investing in a strategy of marketing and supply discipline that we were pretty sure was going to pay off. We shut down McArthur River when uranium was $17 a pound, basically, just close to $18 a pound. And now, obviously, those pounds we left in the ground are worth a heck of a lot more. But that was a very significant investment. And it was important for us to have the balance sheet so that we could self-manage risk. We didn't want to be halfway through that investment and then have to make an awkward lurch to the capital markets and say, well, we took on an investment we just simply couldn't see out. So it was important for us to be very, very financially disciplined. We're still in supply discipline. We still haven't layered in all the contracts that we would want to layer in. Deliberately so, because now's not the time to be sold out. We want leverage to a market that we think is improving. We're planning on bringing back McArthur, but not at full production. Our guidance for 2024 is McArthur will get up to 15 million pounds a year. That's 40% below its licensed capacity. And at that time, our guidance is to bring Cigar Lake back to a lower rate of production. So we're still in supply discipline mode, as we're still in a market discipline mode. So our balance sheet is very strong, and it's to back up just the final, I would say, hard yards of this discipline strategy. But over time, as that book of business builds up and more certainty and predictability around the earnings and the cash flow, it'll give us the opportunity then to step back and say, well, obviously, as a principal, we're not our owner's savings account. Our owners can manage and invest their money far better than we can. So we'll look at the sources and uses. We'll look at our leverage. We'll look at our investment opportunities against our book of business, and at that point we'll make appropriate capital allocation decisions. But at the moment we haven't captured the value that we intend to capture from the turn of this cycle, because it still is early innings.
So Rio Tinto is in the process of, or has a process for its Rough Rider asset. Is this something you and your team would look at, given its location, but also your cash position?
You know, there is the nice thing about the uranium space for us is there's not a project out there that we are not completely aware of and entirely familiar with. And for us, we just see the value coming from our brownfield leverage strategy, taking McArthur from 0 to 15 and 15 to something, and maybe Cigar pulling it back or running it at 18, and there's a phase 2 at Cigar Lake, and we've got an extraordinarily good asset in Kazakhstan with Kazatomprom that's running at 20% below subsoil use, but under the right conditions it could run 20% above. We've got all of this licensed, permitted brownfield infrastructure that is by far the best value driver than anything that smacks of greenfield. So while we look around and we're very active keeping an eye on different opportunities, there's nothing out there that we would obtain, acquire, that we would bring into our portfolio that would actually outcompete the pounds we already know and already own. And that's just a reality of the resource base that we currently sit on. So, gosh, it's not that we're averse to deals, but deals have to add value, and we see more organic value in our current portfolio.
So far more focus on organic growth. Grant, as we wrap up, we are halfway through the year, and it's been a busy one for you and your team with the signing of 40 million pounds of uranium in early January, February, the restart of McArthur River. What else can investors expect from Cameco as we move into the second half of the year?
Well, we hope and we expect that folks just know we're going to do what we say we're going to do. And that when we say we're going to continue to be disciplined on the marketing side, we're going to capture the value where it makes sense to us. We're not going to chase volumes when it doesn't make sense to us. It doesn't make sense to us yet to run all our assets at full production, because while the demand is picking up in the uranium segment, it's not at replacement rates yet, which have always historically been the trigger for really strong price formation. So we'll be patient and we'll wait for that. And we'll continue to be financially disciplined so we can self-manage any of the headwinds that are either, industry specific or more broadly the macro headwinds, and we will self-manage those. So we're gonna continue to do exactly what we said we were going to do, and that is capture as much value over a sustainable cash flow and earnings perspective as we can for our owners.
Well, Grant, I want to thank you very much for making time today. It's always insightful every time we speak. Thank you.